Well, for me, I recognise that, in fact, based on Motor Trader's own research, that half of dealers are expecting or anticipating that residual values should, in fact, be set higher than they are today. But I appreciate this in the light of, particularly the last 18 months when used values have been at an all-time high. For a lender, though, the challenge is to take a view sort of 3 or 4 years out from where we are today. And I think the current trend in used values based on the last month or so and prevailing economic climate, it's clear that there's challenges in making those type of decisions. And certainly from the conversations I've had, I know that dealers recognise this. For Mann Island, we've always taken the view that electric vehicles is BAU. So we don't differentiate on our residual value setting, with the exception of Tesla and the newer sort of marques that come to market. But all the established brands, we adopt the same 85% of cap approach. To add to that, I would sort of say that there are particular issues with EV. I mean, particularly the pace of change, battery life, range, etc., and the potential MQ issues that may come as a result of that. We don't really have enough history to make those judgments today. But I think for me, they are sort of key assessment factors in residual value setting. I think we'll see confidence improve, particularly as we move towards a steady state situation with electric vehicles. However, that pace of change I refer to, coupled with an uncertain economic outlook, will, I suspect, lead some lenders to continue exhibiting some degree of caution, which is perhaps understandable in the current climate. There are clear differences between buying and financing rationales for electric vehicles when it comes to new and used, and obviously for business and personal users as well. The business case, I think it's compelling. There's significant corporation tax and BIK benefits compared to petrol and diesel cars. But of course, they only apply to new and ex-demo vehicles. But from my perspective, I'm confident that this will encourage business users to move to EV, and that will feed the future used car sort of battery electric vehicle market, which is so important. And especially, of course, given the increased range of the latest cars coming to market. I think from a product point of view, the higher purchase price leads people to be favourable towards a PCP or residual value based product. But I think PCP in particular, with the guaranteed value, future value is going to be a prominent factor. And I think for used car buyers, and a personal view would be that the immediate outlook will see an increase in activity led by hybrid vehicles. Recognising they don't have the same potential range as a fully electric vehicle, but still there are savings to be made in clear air zones, in city centres, etc. And I also think that many will see this as a tentative first step towards moving towards a fully electric vehicle, not having quite got their head round or come to terms with the change in mindset that's required to move to a fully electric vehicle in terms of planning journeys, charging points, etc. So I see that as that hybrid piece being prevalent in the next couple of years. Well, I think all products are going to work well. I think it's fair to say that clearly the higher purchase price that exists with electric vehicles will lead clients and customers to a residual value-based product from an affordability perspective around monthly payments. But I can't overstate enough the importance of explaining transparently to customers the implications of each product. It's very easy from a sales perspective to, and it's easier to ask a customer, would you rather pay £600 a month or £575 a month from an affordability point of view based on monthly payments. But I think an equally valid question is to say to the customer, would you rather pay £4,000 worth in interest or £3,500 worth in interest? Because PCP clearly is a more expensive product. So I think it's really important that we're transparent on things like that. I think equally, annual mileage, the implications of excess mileage charges, and if it's a leasing product, the fact that there's no purchase elements available to the client at the end of the agreements. All of these things are really important to be explained to the customer. From our point of view, as I explained earlier, we're treating electric as BAU, so we're offering PCP for periods up to 5 years at the start, or for age of vehicle up to 5 at the start, and 9 years at end, so that's no different to a diesel or a petrol car. And I think overall, dealer finance has a real clear advantage over personal loan, mainly centred on things like the differing options that a dealer has available to offer to a client, all at point of sale with the relevant explanations provided. with the ability to do so at point of sale with all the correct information and pricing. Whether that point of sale be in person in the dealership or indeed online. And I think there's an exciting future ahead for us. I think if you contrast it versus the last 20 years when innovation has been really much incremental in terms of improving speed of serve to dealers and to end user clients, all concentrating on that sort of initial interface with the customer. I think the future is about about 3 years of interaction with a customer to really improve that experience to a far higher degree. And I think that's really about recognising that all parties are looking to do the same, whether it's the manufacturer, the dealer, the finance company, or some independent companies as well. How can we bring that together to really enhance and make that client experience as positive as possible? That for me is where the future lies.